welcome to the Deep Dive. Today we're tackling State Bank of India, SBN. We really need to figure out its core identity.
Right. Is it this solid, long-term bet on India's growth? Like a lifetime investment?
Or is it just hitting a good patch, cyclical high that won't last? That's the conflict we need to resolve for you.
And the scale here is just massive. The research we looked at suggests SBI's asset growth alone added something like $44 billion to global GDP in FY25.
Wow, $44 billion.
Yeah, and get this, that's about 16% of India's entire incremental GDP boost for the year. So yeah, it's a major economic engine.
Okay, that definitely frames the bull case, the idea that SBI is the ultimate India proxy, almost like a part of the government's own balance sheet.
Exactly. Quasi-sovereign is the term often used. But the interesting part for investors, I think, is this sum of the parts angle, the SOTP.
Ah, the hidden value idea. Explain that a bit.
Well, you've got these listed subsidiaries, SBI Life, SBI Cards, the asset management company, all growing fast.
And they're valuable on their own.
Very. Analysts figured those subsidiaries alone are worth around 280 RD per share.
So if you buy SBI stock, you get those subsidiaries, and the value implies that the main bank is cheap.
Precisely. It means you're getting the core banking operation at a pretty steep discount, maybe only 1.0x, 1.2x its projected book value for FY26. That's low.
And then there's YoJoKnow, the super app. That seems like a whole different beast.
Oh, it is. It's not just a banking app. It's seen as this enormous, maybe undervalued strategic asset. Some estimates put its independent value at like 40, even $50 billion.
$50 billion just for the app. Why so high?
Because it's their main defense against fintechs, It keeps customers locked in, handles huge volumes, and helps them pivot. They're moving from just branches to this phygital model, physical plus digital.
Okay, that's a strong bull case. Physical network, cheap core bank, valuable subs, and this massive digital platform.
Right.
But we have to address the bears. Goldman Sachs put a sell rating on it. Their argument is that the profitability, the return on assets, or ROA,
which is currently over 1%,
is just a peak. Unsustainable.
That's the core bear argument, yes. And there are some real near-term pressures. Deposit costs are rising. That directly squeezes their net interest margins, the NIMs.
Less profit on loans, basically.
Essentially, yes. And analysts are flagging some early warning signs. Incipient stress is the phrase used in certain loan books. Think MSMEs, unsecured personal loans.
And didn't we see high non-performing loans in the agriculture segment?
We did. Alarming levels, actually. Almost 8.7% NPLs there. That's not insignificant.
So if stress is showing up, doesn't that lend weight to the sell side? Maybe it's not just cyclical.
It's a valid concern, but the bulls push back, focusing on the bank's structural moat. Its real strength isn't necessarily getting the best loan prices.
It's the funding side.
Exactly. That massive low-cost deposit base, the CI accounts, and the sheer size of their branch network. Over 22,000 branches. Nobody can replicate that easily.
That huge physical presence keeps their funding costs down, right? Helps them ride out these margin squeezes better than others.
That's the idea. And look at the results, the great convergence. SBI's recent return on equity, ROE, hit 19.7% in Q1 FY26.
How does that compare?
Well, look at a top private bank like HDFC. Their ROE was around 14.7%. SBI is actually matching or even beating some private peers now on profitability.
So the argument is the turnaround is real, the balance sheet is fixed, and it deserves a better valuation permanently.
That's the crux of it. The discount it used to trade at compared to private banks should narrow and stay narrow.
Okay, so summarizing the deep dive for you, the verdict seems to lean towards a BUY for the long haul.
Yeah, the forecast suggests at least 10-12% earnings growth per year. That's EPS CAGR. It balances the solid loan growth, maybe 12-14%, against those NIM headwinds we mentioned.
So for you, the investor, it comes down to belief. Is the peak ROA just a temporary storm? Or is the bank's fundamental character flawed?
Our analysis suggests the character has changed fundamentally, for the better. It's not the old slow state bank anymore. It's positioned to lead.
Which brings us to a final thought. Management wants SBI's assets to grow from 20% of India's GDP today to 25% by 2047.
A quarter of the entire economy's financial scale.
Think about that. If SBI becomes that intertwined with the nation's scale, what does that mean for its independence versus, say, political or social goals, compared to a purely profit-driven private bank? Something to consider for the very long term.